Hey, what's up guys? Welcome to another video. In this week's video, we'll take you through the top property stocks that are valued over $1 billion here in New Zealand. We will take you through a comparison of what each company owns, their expansion plans, their performance in the past, and how each company has dealt with the impact of COVID-19. Just before we get started, we just want to say a huge thank you to all the new subscribers and all the current subscribers for showing us so much support. As a small channel, we appreciate every subscriber we get and every like we get on our videos. So if you're new to our channel, make sure to subscribe and hit that like button. We really do appreciate every single one of you. So these three companies that are valued at a market cap of over $1 billion are Kiwi Property Group, Precinct Properties, and Argosy. Now let's begin with what each company owns in terms of their portfolio. Starting with Kiwi Property, their portfolio mainly consists of retail, office, and something they describe as mixed use, which are areas where both retail and offices exist. Taking one of their big properties as an example, Sylvia Park, where both retail shop and office space exist. Currently, Kiwi Property owns 3 of these mixed use properties, Sylvia Park Lifestyle, and Lynn Mall. Moving on to Precinct Properties, they dominate the office sector with buildings such as the PwC Tower in Auckland CBD. Their strategy is clearly office-based. Now for the third, Argosy. This company, as well as having a healthy stake in office space, has taken an approach that the other two do not have. Industrial properties, such as warehouses and production facilities. Unlike Kiwi Property and Precinct Property, who own very large-scale properties, Argosy owns many smaller properties and very few large-scale properties. So their strategy is clearly different from the other two. Now moving forward to each company's location strategy. Both Kiwi Property and Argosy have at least 70% of their properties in Auckland, whereas Precinct Property is split more evenly in Auckland and Wellington.
Now that we know a little bit about these companies, let's look at what they have planned for the future. Kiwi Property seem to have a big focus on their most iconic property, Sylvia Park. In Sylvia Park, their Level 1 Galleria project is now due to open at the end of the year, featuring about 60 new stores. Following the success of the ANZ Oranga office tower, planning is underway for a second commercial building at Sylvia Park, which is expected to include a 14,000 square meter office space and potentially a 140-room hotel. Also, this year they have bought 2 strategic land holdings in Mount Wellington, making Kiwi Property now own almost 12 hectares of industrial property adjacent to Sylvia Park. In Juri, they are advancing to plan to develop their 51 hectares of land holdings into a mixed-use community. This is a massive project featuring a mix of residential, commercial, and retail properties. It aims to create a town centre catering 60,000 people. The government has also announced its plans to invest $2.4 billion to new infrastructures at Juri, including new roads, train stations, and a motorway interchange. Although this is a massive project, the construction will start in 2023 if early, and the plan is 20 years long to match the growth of the area. Now moving on to Precinct Properties. If you live in Auckland, you probably know that Commercial Bay is opening very soon, and Precinct is the owners behind this. Commercial Bay features 18,000 square meters of retail space for over 100 retailers, and 39,000 square meters of office space for their 39-level office tower. Close to the Commercial Bay, they also have a Wynyard Quarter Stage 2 at 10 Madden Street programmed to open this year. In 2019, they acquired 100% of Generator. Generator is a shared workspace provider providing hot desking, co-working space, and private offices. And out of the 20,000 square meter of flexible office spaces in Auckland, Generator makes up 66% of the space. Precinct acquired Generator to be able to provide more enhanced amenity and services for their clients. Now moving on to Argosy. Argosy currently has an $86 million development in Willis Street in Wellington, which will have 11 levels with 12.8 thousand square meters of space. And this property is forecasted to value at $138 million on project completion in 2021. And this year, they have acquired 3 properties totaling $47.9 million, 2 in Auckland and 1 in Wellington. So Argosy's investment strategy is a bit different to Kiwi Property and Precinct. Instead of having a few large properties, they're more focused on diversifying their portfolios through smaller properties. This removes reliance on one sector or one large tenant, which enables them to have better certainty in future income streams. Now let's look at their financials. Since these are real estate rental income based companies, we shouldn't measure their performance simply based on their profit figures from their income statements. This is because revaluation of land is included in the income statements, which is not a cash income. So don't let this kind of title discourage you. Read the full story. Instead, it's better to measure them through funds from operation. This is basically the cash they actually earn, which can be given to the owners. So if you look at these graphs, Kiwi Property roughly generates $100 million, Precinct $80 million, and Argosy $60 million. And the graph shows these stocks grow very slowly, but these kind of stocks pay around 80 to 90% of their funds from operation as dividends. This means at the current price, Kiwi Property at $1.13 will fetch dividend yield of 6%, Precinct at a price of $1.69 will fetch 3.7%, and Argosy at $1.19 would fetch 5.3%. But this year, because of the uncertainty, Kiwi Property have decided to only pay half as much this fiscal year. Otherwise, dividend payout for these companies are very consistent every year. The reason for lower percentage yield for Precinct based on past year's number is because of the commercial bay opening this year, which should increase their income in the next financial year. When we look into their balance sheet, their debt to total asset ratio was all around 37%, which on paper shows their debt is well covered by assets. But things to watch out for here is that if they ever need to sell their property during economic uncertainty, it is likely to take a long time and won't be at the full price, especially for larger properties, like Sylvia Park for Kiwi Property, while Argosy has over $400 million worth of smaller properties which they claim could easily be liquidated.
Now, how has COVID-19 affected these three companies? All three of them have taken the same approach. All of them said that they are committed to working closely with businesses to help them navigate through COVID-19 and negotiate relief packages to support them through this difficult period. Argosy went as far as mentioning that they have waived off $2.8 million in rent for the month of April and May for those most in need. Now, the reasoning behind why all three chose this approach of immense support is not only to be socially responsible, but also to build a stronger long-term relationship with the tenants. Why? Because each company wants to keep their tenants happy so that each company's average lease term stays high. Building strong relationships ensures that the tenants extend the length of their lease, which guarantees consistent income for these companies in the long term. Currently, according to each company's last financial release, Kiwi Property has a weighted average lease term of 4.9 years. Argosy has 6.1 years and Precinct Properties averaging 8.8 years. So all three have amazing averages if you take into consideration their strengths. For Kiwi Property, retail. For Argosy, industrial. And for Precinct Properties, office. So with the COVID impact, Kiwi Property is currently down 27%, Precinct is down 12%, and Argosy is down 16%. Kiwi Property has gone down the most, which results in the highest funds from operation ratio relative to its stock price. However, because they have such a high reliance on retail property, they pose the highest risk out of all the three, as retailers have been badly impacted by the virus. Precinct has gone down the least and has the lowest yield relative to its price. However, with the commercial bay opening very soon, they may surprise us with increased earnings next year. Argosy holds no potential surprise for earnings in terms of high earnings growth or high loss in earnings, as they are not heavily reliant on any one sector or one tenant, and with the ability to liquidate $400 million rather quickly by selling smaller properties, they face the least risk from bankruptcy. That was our comparison on all three property companies. We obviously couldn't fit in every minor detail, as we wanted to keep things short and sharp, but we did our best to fit in what we thought was important. Feel free to leave a comment below if you have any questions. We are happy to explain things and finer details. If not for questions, let us know what property stock you want to buy and why. And as always, make sure to hit that like button and subscribe for weekly videos.
And we'll see you next time.